Hi, and thanks for watching. Today I'm going to show you how to use my real estate after-tax cash flow analysis model. Now, I was taught in grad school that modeling cash flows on an after-tax basis was a fool's errand. And in most cases it is, right? Because no two buyers are the same, and so if you're looking at it from a valuation standpoint, two buyers are going to have very different tax profiles, and therefore looking at cash flows on an after-tax basis just doesn't make sense. Also, government changes tax rates. Additionally, the owner of a property has a different tax treatment each year depending on the income that they have in that year. And so, in most instances, it's not necessary to model all the way to an after-tax point. However, there are cases where this makes sense, right? So let's imagine that you're comparing your property to tax-free municipal bonds, and you want to understand how those two investments compare. This type of analysis will get you closer to an apples-to-apples comparison. Or maybe you're considering buying a zero cash flow triple net deal, and you would need a model such as this in order to understand the benefit of that type of investment. Another scenario where this might make sense is you're looking at two different investments. They have identical before tax returns, but perhaps the depreciation between the two is different, and you want to understand which is a superior investment on an after-tax basis. This type of analysis will get you there. And then finally, maybe your boss just wants to understand what the after-tax returns look like. And this is a great place to start. So with that said, let me jump into this. There are three tabs here. The first tab just tells what version of the model it is, gives you a feel for if there's been any updates that I've made. As with all of the models we have on Adventures and CRE, this model hasn't been used professionally. There's likely errors in the formula, and in fact there's probably better ways. There may not be errors, but there may be better ways to do this. I'd love to hear your feedback, and then as I get that feedback and as I cache those things, I make updates and I change the version notes on this version tab. The next tab is your after-tax analysis on an unlevered basis. So this is before we layer in financing. We want to understand on an unlevered basis what do the returns look like, both before taxes and after taxes. And so you'll see these blue cells. Anytime you see blue font, those are input cells. And so you're going to model to NOI in a separate model. You can either then drop this model into that model, or you can bring those cash flows over into here, but you're going to paste in or link to your net operating income as well as your capital expenditures. You're going to drop in the purchase price less, and you're going to do some calculation on the land value to get to a depreciable basis. Now, if you already know your basis, then you can just go ahead and drop that in here, and these two don't matter. But this right here is going to take your gross purchase price. It's going to pull out the land because you can't depreciate land to get you to your depreciable basis. You're going to need to drop in your income tax rate, recapture tax rate, and capital gains rate in the jurisdiction in which you're at. And then finally, in this tax section, you get the option to choose whether you intend to defer your taxes via a 1031 exchange at the end of this hold period or not. And doing or using this drop-down menu and saying yes or no will help you identify what are the returns doing a 1031 exchange versus what are the after-tax returns not doing a 1031 exchange. And keep in mind, there are still tax ramifications even if you defer your capital gains and your recapture, because you're paying income tax throughout the hold period on the taxable income that you have. Next, you're going to identify whether this is a residential or non-residential property. This matters because if it's residential, you're going to have a different recoverable life than if it's non-residential. Non-residential being, right, your retail, your industrial, office, etc., where your residential would be your apartments. So I'm going to keep this residential. And then the recoverable life for your capital expenditures. Now this varies depending on the type of CapEx that you're going to be putting into the property over the term. I have a blend, I call it 7. If you want to see the recoverable life for different items such as say appliances versus roof, I link here to the IRS publication where they specify or provide guidance as to the depreciable life of different CapEx items. Again, this is going to be your best guess. This isn't a model that you're going to get into much granularity. And then you have your analysis period. If you want to have this be fewer You can do that. You can do more. If you want to go out beyond 10, you just go ahead and copy all of these cells over to the right, and you can expand your analysis period out to infinity if you'd like. And then net terminal value. This is a value, again, you're bringing in from the model where you're modeling out what your returns look like, as well as what your residual or your sales price is going to be at the end of the hold period, in this case, $20 million. And as a result, based on these cash flows and these inputs, this is what we project the before-tax unlevered IRR to be, 8.35. And this is the equity multiple before tax on an unlevered basis. But then looking after tax, because of the capital gains, the recapture tax paid, and the income tax paid throughout the hold, the IRR is diluted to a 5.92%, and the equity multiple to a 1.63. Now, if we want to look at this, deferring our capital gains and depreciation recapture at the end of the hold, that after tax, as you can imagine, IRR increases 7.28, but again, 5.92 paying tax. Then if we want to layer in financing, so you come to this next tab. The majority of the inputs from the previous tab flow into here. The only additional inputs you'll need to drop in the loan amount. You'll need to drop in the interest rate for that loan, and then the amortization. I didn't offer the option to add interest only, etc. You could do that if that's something that you're needing or wanting. But again, at this point, this is a simple look at your after-tax cash flows. And then based on this financing, these are your after-tax IRR and equity multiple. And then again, before tax. So that's the after-tax analysis model. Let me know if you have any questions, and thanks for watching.